Yes, people, a very, very happy evening to all of you. Thank you so much. So, guys, we are in the revision series, and the chapter that we are going to revise today is Introduction to Accounting Standard, which is chapter number 1 of your study material. So, in this chapter, what are we going to revise, people? We'll try to first of all understand what is the meaning of gap. Second, we'll try to understand what is the evolution of IAS and IFRS. Then we'll try to understand what are the different types of accounting standard that we follow in India, which is accounting standard and Ind AS. What is the meaning of accounting standard? We'll learn that. Then we'll try to understand that in what manner the accounting standard is issued to the various entities who are supposed to follow the accounting standard. Then we'll try to understand the background of how we conversed Ind AS with IFRS, or rather how accounting standard was conversed with IFRS to create Ind AS. So this is what I'm going to summarize. And at the end of the session, I'm going to do a quick MCQs from your study mat and the extra questions that I have prepared. So guys, the full form of GAP is, it is generally accepted accounting principle, right? What is the meaning of this? Sir, this is a framework. It's a framework under which every country is required to prepare their own accounting standard. The accounting standard which we will follow for preparing the financial statement. Got it? Not got it? So there are multiple differential accounting treatment. So there is a need to standardize all of them. So the process of standardizing the various accounting treatment is called as accounting standard. And to prepare this accounting standard, we need to have a base, we need to have a foundation. So that base, that foundation is coming from GAP. Sir, why is not GAP telling us do this or do that in particular? GAP cannot say that because every country's got their own legal environments, business environments, and economic environments. So no country can say that this is the accounting standard that everyone has to follow. So the flexibility has to be given to respective countries to create the accounting standards which will best suit their economic conditions, legal conditions, and business conditions. But at the same time, also we have to keep in mind that you can't give so much of freedom to these people that the accounting standard what they develop is totally different. Because if accounting standard what these countries develop are totally in each corner, it is going up now, then the financial statement that you're preparing will not be comparable. There are few essential characteristics of a financial statement. Can you please tell what is that? A financial statement should be, first of all, transparent. Very important. It should be transparent. Okay. Spelling of transparent. The characteristics of a financial statement is that first thing, it has to be transparent. What is the meaning of transparency? All the data that you present in the financial statement should be true and fair. There should not be any hidden agenda. If there is something that is happening inside your company, if that is not reported or if that is not accounted up, then the financial statement what you're preparing and presenting is not transparent. If a financial statement is not transparent, if it is not communicating things effectively and efficiently, then I, as a user of the financial statement who is studying this financial statement, might end up taking wrong decision. So my decisions, if it has to be right, then it is important that the financial statement that you present to me should be transparent. There should not be any hidden agenda behind it. Got it? Not got it? Got it. Second characteristics of any financial statement. It should be understandable. First thing, it should be understandable. You cannot present a financial statement to the user or any investor which he or she cannot understand or which the companies cannot understand. So the financial statement what you prepare and present should be understandable to people, because using that financial statement only, I as an investor am deciding whether should I invest in your company or not. So if you present some data to me which I cannot understand, then I will lose confidence in your financial statement. I will lose confidence in your business. Then I might not invest in your company. So therefore, to seize this, to grab this opportunity, it is very important that we prepare a financial statement which is understandable by companies or investors or stakeholders. Third, the financial statement that you prepare every year should be consistent and uniform. It cannot happen this way that Current year you're following WDV method, next year you're following SLM method, then third year WDV method, fourth year SLM method. In valuation of inventory, it cannot happen like that. Current year you're following FIFO method, next year weighted average method, third year LIFO method. You can't keep on changing. So whatever accounting policies you're adopting, you have to ensure that they are uniformly followed every year and you have to be consistent with it. Got it, not got it. Only then the financial statement that you prepare is understandable. Next, fourth point. It should be comparable. Correct, no? If I go to any, let's say, electronic shop, let's say I want to buy AC. What do? We compare AC, with multiple brands. We take LG ka AC, we take Samsung ka AC. We try to compare. How do I compare? I compare a 210 AC with a 210 AC. 210 AC of LG with 210 AC of Samsung. So the base is what for comparability? That both are product of 210. Can I compare a 210 AC with 1.5 ton AC? No, because underlying basis itself is different. The performance of a 1.5 ton AC is different when I compare with the 210 AC. So therefore, to ensure comparability, the financial statement that you prepare should be consistent, uniform, understandable. So comparability will make people understand the performance of the business compared to current year versus previous year. For example, I as investor want to invest in your company. So I will see whether you are on a growth track or not. So current year ka financial statement I'll compare with the previous year. Let's say previous year ka turnover is 2 crore. Current year ka turnover is 3 crore. So compared to previous year, your performance is better or not better? It is better. Better by how much crore? 1 crore. But the problem here is that previous year, the turnover that you prepared, that you recorded revenue was on cash basis. And this year it is accrual basis. So is it comparable now? No. Since you have not followed consistent accounting policies, the financial statement that you're preparing is not comparable. If it is not comparable, I cannot make decisions. Got it, not got it. So you have to ensure that the financial statement that you're preparing should be comparable. Only then I will be able to make a decision whether to invest in your company or not. Fifth one is the data that you are giving to me should be reliable and relevant. You cannot present me any data which is irrelevant. My decision to invest in your company or not will depend on certain important factors. It will depend on your turnover. It will depend on your profitability. It will depend on your what is the kind of gross margin that this product is providing in your business type. Like that, there's so many parameters I want to know. So those information you should try to present to me through financial statement. If you do not give adequate information in the financial statement, if adequate reporting is not done in the financial statement, if the data is not relevant to me, you're trying to present some irrelevant information up to now, I cannot make any decisions based on that. Since I'm not able to make any decisions, my confidence in your company will lose. And thereby, I will not be able to invest in your company. Therefore, the financial statement that you prepare should be relevant to my decision making, and I should be able to rely on that very comfortably. So now, the financial statement that you prepare should have all of these qualities and characteristics into it. Only then the financial statement will be considered for the purpose of, let's say, investment. Now, to ensure all of these characteristics or qualitative characteristics of financial statement is met, it is very important that we have accounting standards in place. Accounting standard in place. Accounting standard means what? Since we have differential accounting treatment, now there's a need for standardizing those accounting treatment. So now the standardization of the accounting treatment was done by accounting standards. Accounting standards. Now, how to prepare the accounting standards? For that, a guideline should be given or not given. It has to be given. So guideline of how to prepare the accounting standard was given in GAAP. So GAAP is basically framed by various accounting experts across the world. They came together and said that there are certain accepted accounting principles which every country has to follow while framing their own accounting standards. For example, when you are preparing your accounting standards, you have to ensure that the matching concept is not deviated. That's why in accounting standard 10, which talks about property, plant, equipment, what do? Let's suppose I'm buying a machinery worth 10 lakh rupees. Do I record this entire 10 lakh rupees as expenditure in P&L? No. We take it to the balance sheet. If I'm using this asset for 10 years, then I will depreciate this asset for 10 years and record expenditure. I'll scatter the expenditure. I'll allocate the expenditure. I'll amortize the expenditure over a period of 10 years, 1 lakh each. Means what? Since I'm deriving benefit from this machine for 10 years, Since I'm getting benefit from this for 10 years, I should record its proportion expenditure also for 10 years. So expenditure and its benefit should match. So AS10 satisfies matching concept. Then GAP said that while preparing your accounting standards, you have to ensure that the prudence concept has been taken care of. That's why if you see in accounting standard 2, which talks about valuation of inventories, they said that inventory should be valued at cost or NRV, whichever is lower. Now this is considering the prudence concept. So like that, they have said that whenever you draft any accounting standard, in that the going concern ka concept, consistency ka concept, accrual basis ka concept, prudence, materiality, matching concept, everything should be taken care of. Which means there are certain fundamental accounting assumptions and there are fundamental accounting concepts which has to be considered while drafting accounting standards. Who said this? GAP. So what is GAP? GAP is basically refers to common set of accepted accounting principles. Accepted by whom? The accounting experts worldwide have said that if any accounting standard has got these essential features and characteristics aptina, then the financial statement that you prepare is comparable, relevant, understandable, what you call transparent, etc., etc., etc. So these GAP is nothing but set of accepted accounting principles, or you say standards or procedures, which is used by the business reporting entities for preparing and presenting the financial statement. Correct? Now this GAP is being again customized by respective countries. If you say US did not accept this GAP as it is. They did modification wherever required. Though people want that if you deviate too much from the GAP, then your financial statement may not be relevant to us and you might lose the opportunity of getting the funds. You might lose it. But still they said, no, we want to have our own GAP. Like that, every countries try to modify this GAP, which will suit best to their economic and legal conditions. But more or less 99% they felt that they will try to keep it same. So GAP is a framework that outlines the accounting standards, principles and procedure that guides how the financial statement should be prepared and presented. However, GAP is not a single universal law. Hey, do this, hey, do that. Like that, they can't comment. They have given a framework. They've given a boundary line, which will give you a flexibility and freedom to prepare the accounting standard, which will best suit your economic conditions, legal conditions, and business conditions. It provides a broad conceptual foundation that allows country to align their local accounting practices with global accepted norms and also adopt or create specific rules which will suit their legal, economic, and business environments. So basically, this GAP is very, 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 very flexible framework. It's a very broad framework within which all of you have to develop your accounting standards. If anybody goes out of it, is there any penalty or prosecution involved? Nobody is going to tell you anything. So if you want to go out of the GAP and prepare something also, you can do it. But if you prepare any accounting standard which is going out of the framework of GAP, then we believe that that kind of accounting standard is not reliable or consistent or uniform. Means when any financial statement is prepared using such accounting standards, then we will lose all of this characteristics of the financial statement. Got it, not got it? Now, so in India, we have something called as Indian GAAP. Under Indian GAAP, we have two accounting standards. One is accounting standard, second is NDS. US has got their own GAAP called as US GAAP. UK has got their own GAAP called as UK GAAP. Then Japanese has got their own GAAP called as Japanese GAAP. Got it, not got it? Couple of countries put together come out with international GAAP called as IFRS. Now, why we have different gaps? Because every country has different legal, economic, and business environment, and therefore it is a need to customize and keep the foundation and the fundamental of GAAP as a base. So here we have kept GAAP as a base, but wherever required, little bit customization we have done, and we have come out with Indian GAAP or US GAAP. Little bit modification here and there they have done, but more or less the base is what? GAAP only. On that they have structured something called as Indian GAAP and US GAAP. On this they are building something called as accounting standard or INT AS. Got it, not got it? So base of accounting standard is Indian GAAP. Indian GAAP ka base is what? GAAP, which is nothing but international GAAP. So if you follow GAAP while drafting accounting standard, we believe that the financial statement that you prepare will be true and fair. The financial reporting that you do will be a standardized report. A standardized financial reporting will be ensuring that you can compare the data of one country with another country. The comparability will be ensured, reliability will be ensured, transparency will be ensured. So basically, all this will be ensured. All these points will be ensured if you follow GAAP. Okay. Next, let's talk about the evolution of IAS and IFRS. So all of you know that in 1929, what happened? Great Depression. What happened during that period? There's a crash in stock market. Which stock market? New York stock market, in the Wall Street. There was a huge crash. Why this crash happened? Because the financial statement that they prepared was not having a strong accounting standard as a base. People did the reporting the way they felt like doing it. People did the reporting the way they felt like doing it. At the end of the day, what happened? They blowed, things got blown out of proportion. And when people got to know, how things were, blown out of proportion and manipulation happened, then people started losing the trust on those companies' financial statement. Ultimately, collapse happened. For example, all of you know that something called a stock market. What happens in stock market? People buy and sell shares of various companies. Can you please tell me what could be the possible reason for a particular company share price to go up? Generally, in an organic way, if the share price has to go up, what could be the possible reason? One, the company's performance compared to last year is improved. It got better. So you feel that, okay, if I invest in this company today, next year, more profit means more better performances and more chances that I'll get a good dividend. Okay, second reason. Demand. Okay, we have come across information where the government of the respective, let's say government of India, has done a tie-up with, or let's say given an order to Reliance Industries that we will be dealing with you for so much crores of rupees. So looking at this information, you feel that this is going to, give a bright future to the company that is in future, because we have a good order book now. What is order book? Future order book. Today, we have got an order from the government that future will buy so much of goods from you. So that is securing my future. So looking at that, you will naturally buy the shares of the company. Since the demand is created, naturally the stock price will move up. So these are the organic way of moving the stock price up. There's a genuine reason behind the stock price moving up. But back in 1929, what happened is these stock price were artificially made to move upwards. Right? A point came where a 5 rupee worth of share, in no time it became 5,000 rupees. So there was no real value addition to that share price. At the end, what happened is when people got to know, there's something wrong in the company, in panic, people started selling the shares and drastically the stock market crashed. And then when they dig inside more to understand what went wrong, then they understood that the financial reporting, what was done, was not done in true spirit. There's lack of transparency, understandability, comparability, relevance, everything. There's no proper information given. So people who were investing in the company could not decide on what basis to invest in the company. Left, right, and center, how they got information. They picked that information, based on that they invested in the company. So imagine if every country is going to have such kind of environment where the stock price is moving not genuinely but is moving artificially. Imagine every country is going to face such crash in the stock market, which is not good for that country's economy, So they realized that no, we have to have a standardized accounting procedure which will ensure that the financial statement that is prepared is lot more transparent, lot more informative, so that any investor deciding to invest in that company can make a calculative move to invest in the company, make a calculative decision whether to invest in that company or not. So therefore, worldwide, we all agreed that it is important to have a international accounting standards. So for this purpose, they formed one committee called as International Accounting Standard Committee. Shortly and sweetly called this as IASC. This was constituted in the year 1973. The objective of this IASC committee was to develop and promote international accounting standards. So it identified which are all the problematic area where the business entities are having difficulty in accounting. So they gave solution to those problems through international accounting standards. Plus, they try to, go out in the country, that is within the country and across multiple countries, and they convince, please adopt IAS. By doing that, the financial statement that you prepare at the global level will be uniform, which will lead to comparability. So they started promoting IAS across multiple countries. So IAS were first globally recognized accounting standards. This committee was operational from 1973 to 2001. During this period, IASC issued in total 41 international accounting standards. These international accounting standards essentially focused on what should be the ideal accounting policies that the company should adopt. What should be the differential treatment for recording income, recording expenses, recording asset, recording liabilities. Apart from recognition, is there any other additional disclosure which is required, which can influence the decision making of the user of financial statement? If that is required, they emphasized on disclosure also. So this IAS that they drafted considered all of these aspects. Unfortunately, this committee became little outdated. They could not move to the trend, the trend that we were developing that time. No, that is in early 2000. The countries across the globe were moving at a very fast pace. Lot of new changes were coming into the different countries. So this IAC committee was not able to give solution to those problems. So therefore they felt that we have to restructure this IASC. So in 2001, they scrapped this committee and they created a new board called as International Accounting Standard Board. So in 2001, IASC was restructured into a more independent and technically focused body called as IASB. Now, what is the objective of having this IASB? The objective of this IASB was to again develop and promote something called as International Financial Reporting Standard, IFRS, which is more robust accounting standard than compared to the IAS. So this was more robust, more focused, more independent standards, giving more clarity, more what do you call it? Then what was given by IAS? This led to the financial reporting that was done at the global level. No, it became more transparent, more comparable, and more robust. And by this virtue, the capital, the funding that we got, the flow of money that happened between the countries were much better when people adopted IFRS based financial reporting. Not just that, people were able to comfortably list the shares in the stock market of the other countries, because IFRS gave that kind of financial reporting where the financial reporting or financial statement was more understandable, more reliable, more comparable, etc., etc. Whether you say IAS or IFRS, both are principle based set of standards. Means what? They didn't come out with a lot of rigid points that this is the only way to do the accounting for a particular item. You are given freedom to do accounting for a particular item in more than one way or two way or three way. Whereas rule based accounting means what? The options are very much curtailed. So in India, we have something called as accounting standard, which is called as rule based accounting standard, where the options are very much restricted compared to what is given in IFRS. Hence, IFRS is called as principle based, and IND-AS is called AS is called as rule based. IFRS and IND-AS both are principle based, and AS is called as rule based. Now, what is the difference between principle and rule? If I have to give an example, if I tell you when you come for the class, you should wear only white shirt and black pant. Only white shirt and black pant. That is called as rule based. I'm being more specific to you. I'm not giving you choices and options. I'm restricting your choices and options. That is called as rule based. But when I give a little bit more freedom, telling that you can wear shirt and pant of whatever color you want, but you have to come in formal and neat clothes. That is called as principle based. So you have more choices now to wear the color what you feel like wearing. Now, what is the role and function of IASB? The function of IASB was to develop IFRS, improve IAS. There were some IAS which are actually, good, genuine. Even if we follow now, it is a good one to follow. Therefore, these IAS, wherever required, the improvisation was done. But there were certain IAS which were totally, outdated. So they scrapped it and they came out with a new concept called as IFRS. So IASB issued new accounting standard called as IFRS, having its headquarters located in UK. So this IASB had its office located in UK. And this board did not scrap all the IAS. Wherever required, few IAS were scrapped, and wherever required, few IAS were revised and updated, which can match the current requirement. Not just that, this IASB was also given the responsibility to work with various nation standard setters. That is, You have to go and work with multiple countries. So in India, you have to work with ICAI so that ICAI can come out with the proper accounting standards, which is a standard which everybody can understand, a language which everyone can understand. So one of the function of ISB was to promote or converge, that is work with national standard setters like ICAI in India to promote either IFRS as adoption strategy or convergence strategy. So IFRS, either you make people adopt as it is or you encourage them to converge with our IFRS. So by this virtue, the financial statement that you prepare was transparent, comparable, same information. Now, a summary chart between IAS and IFRS. IAS was issued by IASC, full form International Accounting Standard Committee, whereas IFRS is issued by IASB, full form International Accounting Standard Board. This IASC was operational during the period 1973 to 2001, during which period they have issued 41 international accounting standards, which was later scrapped, but still some of them are used even today. Some are still valid today, others are scrapped. Whereas IASB was formed from 2001 and onwards, and they are present operative even till now. During this period, a total of 17 IFRS has been developed. Apart from that, there are few IAS which is modified and updated, which is being followed along with this IFRS. And they are continuously working to develop this IFRS in multiple other sectors. Okay, not okay. Now, which are all the country who has gone for full adoption of IFRS? IFRS used as issued by ASB. That is, they have adopted full IFRS as it is, not even one letter change. Full as it is adopted is by those countries, which is United Kingdom, Germany, France, Australia, Canada, South Africa, Brazil, etc., etc. Which means these are some countries who adopted the IFRS as it is without any change. So they followed adoption strategy. Whereas some countries felt that this IFRS, what you're suggesting, may not suit our economic, legal, business environments. Therefore, it is important for us to converge with it. So local standards, let's say in India, we have accounting standards. So that got converged with IFRS. So that strategy is called as convergence strategy. That is called as convergence strategy. So in India, we have something called as Ind AS. So Ind AS is nothing but accounting standard converged with IFRS. Likewise, Japan, China, and South Korea, all of them have opted for convergence strategy. But there's one country who is still not neither adopted nor converged, which is United States of America. So they have their own national standards, uses US GAAP, and they are issued by FASB and not following any IFRS issued by IASB. Got it, not got it? Fantastic. So far clear? Is the pace too fast or fine? This pace is fine? Okay. Now, types of standard applicable in India. Types of accounting standard applicable in India. There are two types of accounting standard that we deal with. One is called as just accounting standard, and second is called as Indian Ind AS, that is Indian accounting standards. If I have to tell accounting standard, this is nothing but local accounting language, and this is called as international accounting language. Got it, not got it? Oh, now, what is the meaning of accounting standard? Accounting standard is a set of written policy document. It's a written policy document formulated by Accounting Standard Board. This Accounting Standard Board is constituted under ICAI. So ICAI, being the premier accounting body in the country, has taken up the leadership role that we will come forward and help the country, government of India, to formulate a robust accounting standard. For this reason, ICAI constituted one board called as Accounting Standard Board. Like how ICAI has got something called as BOS. What is BOS? Board of Studies. Can you please tell me what is the role of Board of Studies? They are the one to decide how many levels of CA examination should be there. What should be the subjects for each level? What should be the syllabus for each level? What should be the exam paper pattern, etc., etc. So they have regulated this course of CA very smoothly. So there are independent people who are relentlessly working day in and day out to develop this CA course and promote the CA course across the country. Likewise, the ICAI constituted one separate independent board called as accounting standard board who are given the responsibility to develop the accounting standards for the country. So AS is a set of written policy document formulated by ASB of ICI under what framework? GAP framework. This is the base on which the accounting standards are developed, and this is issued by ICI. So it is formulated by ASB and finally issued by ICAI. Now, whatever AS is issued by ICI, it is compulsory to follow if you are a non-corporate. If you are a non-corporate, non-corporate means what? If you are a sole proprietorship concern or partnership concern or LLP business, you are called as non-corporate. For these people, AS is required to be followed. AS is required to be followed just if ICI issues it. But however, if you are a corporate, then AS issued by ICI is not sufficient. So MCA comes into picture and they say that we will notify the AS recommended by ICI, but they will not notify this blindly. Before notifying this, MCA will take consultation or inputs from an independent body called as NFRA. The full form of NFRA is National Financial Reporting Authority. So MCA, after consulting with NFRA, will then notify, and once MCA notifies, it is mandatory for all the companies to follow the accounting standards. Now, in the next chapter, we'll study about applicability of accounting standard. The next division what that we'll do is it's called as applicability of accounting standard. In that, you will learn that there are multiple levels: level 1, level 2, level 3, level 4. We were using this level until last year. Last year, 2025, all this level were renamed into a different thing. So level 1 entities are now referred to as large entities. Now, level 2 entities are referred to as medium entity. Level 3 entities now referred to as small entity, and level 4 is called as micro. So we had 4 different levels, no? They combined all of them into 2 levels. One is called as large entity, second is called as MSME. Got it, not got it? So these both entities, large entities and MSME, are part of your non-corporates. So if you're a partnership concern who is either a large entity or MSME, you have to follow the accounting standard issued by ICI. No need to wait for MCA's notification, because MCA cannot give any notification to non-corporates. So MCA's notification is having a binding effect on whom? Corporates, on corporates. Now, what is the role of accounting standard board? The role, it's okay. The function, there is development and formulation of accounting standard. What is the function of ASB? They are here to develop and formulate accounting standards. So when was this ASB formed, people? This ASB was formed, that is constituted by ICI in the year 1977. In the year 1977, this board was framed, constituted, formed. The primary role of this board is to draft and formulate accounting standards in India. This ASB comprises of multiple people. In short, if I have to tell you, the ASB board comprises of members of ICI, the elected members of ICI. There are selected people telling that you go to this board and take up the role of drafting and formulating AS. But ASB alone does not comprise of members of ICI. With that, we have different other members called as representative of different industries. Please tell me, the challenges in accounting is faced by whom? ICI? Or is it these industry people, manufacturing industry people, service people who are actually doing the accounting on day-to-day basis, who are facing the challenges? These are the people who are facing the challenges. So it is important that we select the representative from different industries. Some lead from manufacturing industry, somebody from service industry, somebody from banking industry. So we used to have representative from each of these industry who will come and be a part of this board, so that these members of ICI can discuss with them to understand what is their ground problem, because they are the people working in the ground. So at the ground level, what problem is that? The true picture of that, who can give? These people who are representing the different industries. Apart from that, in this board, we have different other people called as regulators. Can you give me one example of regulators? RBI, SEBI. So these people also will give the inputs whether these accounting standards are okay or not okay. Plus government departments such as MCA. Right? So they will give input whether the accounting standard is okay or not okay. Likewise, academicians and professional people, all of these people comprise and become a part of ASB. So ASB engages with various industry bodies, regulators, academicians, and professionals, and then decide what AS should be framed and issued. Now, this part I'll discuss later. This also I'll discuss later. This also I'll discuss later because we have a step-by-step procedure on how the AS needs to be issued. In that, I'll be covering all of this. So again, let's not do it. Now, what is the role of MCA? What is the role of MCA? Function of MCA. Statutory notification and enforcement of AS for companies. So MCA will give notification and they will enforce the companies to follow AS. Got it? Not got it? So empowered. So this MCA, who has given the authority to MCA for notifying the accounting standard to be made applicable on companies? It is Companies Act 2013. So empowered under Companies Act 2013 to approve and notify the prescribed accounting standards. So MCA gets authority from Companies Act 2013 to approve and notify the accounting standard to be made applicable on companies. Notification. MCA reviews AS recommended by ICI. So AS is recommended by ICI to MCA. MCA will review that after consulting with NFRA, and if they find appropriate, they will notify this. They will notify them. And once it is notified, it is legally applicable on the companies. So MCA reviews AS recommended by ICI and notify them legally after consulting with NFRA, empowered under Section 133 of Companies Act 2013. So now, Section 133 talks about what? Section 133 talks about the consultation to be done with NFRA. So MCA has been informed under Section 133 that you have to consult with NFRA before you notify the accounting standard. Got it? Not got it? Okay. Now, where does MCA notify this? Now, in Companies Accounting Standard Rule 2006, in which act? Under Companies Act 1956, the notification was given under Companies Accounting Standard Rule 2006. Now, Companies Act 1956 is scrapped and replaced by Companies Act 2013. In Companies Act 2013, now this 2006 is replaced with 2021. So in Companies Accounting Standard Rule 2021, this is a place where you can see the notification given by MCA for the applicability of accounting standards for companies. So if I'm a company whom accounting standard is applicable, so if I want to check where is the notification, this notification I'll go and search where? In Companies Accounting Standard Rule 2021, in 2021. However, if I'm a company on whom Ind AS is applicable, so I want to see where the notification is given up to now, I will go and check Companies Indian Accounting Standard Rule 2015. So here we have notification of Ind AS applicable on certain other companies. So these and these both are different. So in the next chapter, we learn that which are all the companies on whom accounting standard is applicable and which are all the companies on whom the Ind AS is applicable. So these are the place where the notification has been laid down. Got it? Not got it? Now, was all this AS and Ind AS were being asked to follow right from day one? No. Especially Ind AS, we implemented them in the phased manner. So when did the implementation of Ind AS start? When was the implementation of Ind AS start? In 2015. In 2015, certain set of companies were said that follow Ind AS. Which companies? Those companies, listed companies, those listed companies having net worth more than 500 crores. That is 500 or more crores. That is 500 or more crores. The net worth is, you have to follow Ind AS. Whereas in the second phase, then we targeted those companies whose net worth is 250 crores or more. Like that, in phased manner, they implemented Ind AS. Now, what is the role of NFRA? The role of NFRA is very broad, but I'm discussing now only in the context of AS. Their function is to oversight and monitor the compliance of AS for the company. Means whatever the AS is applicable for the companies, whether are they complying with that or not, they have to keep an eye on the companies. Whether they're following or not following, it is the job of the NFRA. Apart from ICI, they have to monitor whether these companies are complying with AS or not, whether they're complying with Ind AS or not. How did this NFRA got into picture? What is the date of birth of this NFRA? How this NFRA was born? NFRA was established or born under Section 132 of Companies Act 2013. So creation of NFRA happened in Section 132. So what is given in 133? In 133, MCA was informed that you have to notify AS only in consultation with NFRA. So there, Section 133 talks about consultation with NFRA. Whereas in Section 132, the birth of NFRA happened. So NFRA got established under Section 132 of Companies Act 2013. So they have multiple roles. If you go to Section 132, you'll understand what is the different roles of NFRA. In that, one such role is what? To comply with the, to ensure that all the companies are complying with the notified accounting standard. So if I'm a company, whether I'm following proper accounting standard or not, to monitor that, NFRA will play a very important role. Scope: regulates and monitors large listed companies, bank, insurance, etc. Apart from that, reviews auditor and audit quality of the prescribed class of companies. Whether for a prescribed class of the company, are the auditors doing the qualitative audit or not, that also they will supervise. So ICA is doing the audit. They are the maker. There's somebody independent who will check. There's something called as maker and checker concept. No. So ICA is the maker of the audit. Somebody should be there to check whether ICA is doing the job properly or not. So NFR has been deployed with that activity. Apart from that, they also have the advisory role. They advise MC on the matters relating to accounting standards and auditing standards. Objective of the accounting standards, same what we discussed earlier. I'm not going through one more time. Now, very important. Guys, when ASB is developing accounting standard, they have to keep in mind or consider 4 aspects while formulating or drafting accounting standard. The 4 aspects which ASB has to deal with while preparing AS or developing AS is that: 1 is called as recognition aspect. Second is measurement aspect. Third is presentation aspect. Fourth is disclosure aspect. I'll give an example. So there's particular company who's got a total debtor worth 1 lakh rupees. There are many debtors from whom this company has to receive 1 lakh rupees. Out of so many debtors, there's one particular debtor from whom we have to collect 25,000 rupees. It's been long pending to receive this money. It's been several months or years that we have not got this money from this particular debtor. So during audit process, when we try to inquire that why this money is not come, the client said, the business said that there is a bankruptcy case that is running, for this particular person in the court of law. In the court, there's a bankruptcy case running on this particular person. Therefore, this person at the moment, we are not sure whether will he pay the money or not. So now the question mark that came is, in such scenario, for this 25,000 rupees, should we create any provision or not? Now that accounting standards are in place, you know very well that in this case situation, provision needs to be created. But what are the guidelines for it? What are the points considering which the provision should be created or not? So if you take accounting standard 29, in that they have laid down the certain conditions. If all those conditions are satisfied, then you have to recognize this provision in the books of accounts. So recognition aspect talks about when and how to record a transaction in the books of accounts. A transaction or an event, when to record, how to record. When to record means at what point of time we have to record this, in which financial year we have to record it. And if you're recording it, what should be the entry for it? So when and how the transaction or an event should be recorded, that clarity is being given in the recognition aspect. Recognition of transaction and event. Now one more example I'll give. To take this example, there's this particular person. On 1st March, he sent chocolates to customer for sample tasting purpose, not testing, sample tasting purpose. Client liked the chocolates, and on 15th March, he gave the samples, he approved the samples given by the customers. The customers approved the samples. On 20 March, the invoice has been prepared. Means what? The billing of the product has been done. 25th March, the chocolate is removed from the factory and sent to the transport office for the transportation purpose. 31st March, chocolate is loaded and it is in transit. 4th April, chocolate is reached the buyer's city, point of entry. 10th April, chocolate reached customer's shop. And 15th April 25, receive payment from customer. The question that is asked here is, on what date or in which financial year am I supposed to record a sale entry? Should I record the sale just because the invoice is prepared? Should I record the sale entry here? Or should I record the sale entry upon removal of goods from the factory? Or should I record the sale when the customer has received the product in hand? Or should I record the sale when the money is being paid by the customer? So wherever we have problematic areas, these areas are picked up by ASB and they provide solution for these problems. Got it, not got it. It does not stop here, people. It does not stop here. I'll give one more example. Let me take my own example. Let's suppose I'm charging a fee of 60 or 6,000 rupees from students for my revision batch. January 1, the revision batch is started. It ends on, let's suppose, 30th of June. All of you know that Jan, Feb, March falls into one financial year, which is 24-25. Whereas April, May, June falls in financial year 25-26. Now, the service for the 6,000 rupees is given in 2 financial year, 3 months of one financial year and 3 months of other financial year. Now, the confusion what people have is that, should I record the full 6,000 rupees as income in 24-25? Why? Because the money is received here. Since money is received here, can I record the entire money received as income? First doubt. Or second, people says, no, how can I record that? Since service is not completely given, you can't record it. So you will record the income only when the service is fully provided. So somebody is suggesting option 2, record 6,000 as income in the next year after the completion of service. Some people say that, no, both option 1, 2 are wrong. Go with option 3. Option 3 means what? From January, February, March, for this period, you give service, no. For this, you proportionally record income. For remaining 3,000, you take it as liability for 31st March 25 because service is not yet provided. If service is not yet provided during this period, do I have the obligation to refund? Yes. So anything that I have to pay in future is liability. So they're telling that half 3,000 treat as income of 24-25 and remaining 3,000 show it as liability. And this 3,000 liability will be recorded as income in the next year when the service is provided. So 3 different options. So again, can I say people are getting confused here? When to record the sale? When to record the income? Yes. So now the solution for this is given in Accounting Standard 9. They have told the parameters basis on which these income should be recorded. So recognition means we are trying to give a solution that when and how a transaction or an event should be recorded. Okay, not okay. Now that you've decided when to record, how to record, the question is, what should be the value of the transaction? What should be the value of event? For example, you tell me people, closing stock that I have to record. The entry for that is closing stock account debit to trading account. Okay. Now the question is, what should be the value of the closing stock? Okay. Before that, my question to all of you, closing stock entry, what you're passing now, is it a transaction or an event? It is an event, all of you know by now. Okay. Now the question is, what should be the valuation of the inventory? So AS2 says that inventory should be valued at cost or NRV, whichever is less. So that is nothing but an answer to the measurement aspect. So they're telling us what should be the value of the transaction. What should be the value of the transaction? So measurement of a transaction event means at what price or at what value should I record the entry? How much to record? At what value should I record? Got it, not got it? Using these two, I'll be able to pass the journal entry. Using these two, I'll be able to pass the journal entry. Next confusion comes is that a particular data, how do I present in the financial statement? How do I present it in the P&L account? And how do I present in the balance sheet? For example, the 25,000 example what I gave you. Let's say you decided to create a provision. Let's say we have decided to create a provision. Can you please tell me the journal entry for creating the provision for doubtful debt? P&L account debit all expense and losses. 2. Provision for doubtful debts. 25,000. So recognition aspect told you at what date you should record this and how to record also, how the entry should be passed. And measurement aspect told you how this amount has been derived. Now the question is, this PFD is credited. If any ledger is credited and there is nothing in the debit side, this ledger will have what balance, people? It will have credit balance. All the ledger having credit balance will travel where in the balance sheet? It will go to the liability side of balance sheet. So if I open the balance sheet, on the liability side, provision for doubtful debt will come. How much? 25,000. If I let this presentation be like this itself, will it not create confusion? Because normally people think liability as what? Anything that I have to pay in future is liability. So if I show this 25,000 on liability side, so any person who's reading this will understand that, okay, this 25,000 we have to pay to somebody. Is this presentation right? No. So therefore, accounting standard said that we have to regroup this to the asset side. So this T-shaped format is like your mathematics. Liability side is equal to left hand side. Asset is equal to your right hand side. And center line is like your equal to. So from left hand side, if anything goes to right hand side, plus becomes minus. Minus becomes plus. This is plus 25,000. When it goes to other side, it becomes minus 25,000. So from where are you supposed to minus this? Debtor. So whatever is debtor, let's say debtor is 1 lakh. From that, minus provision for doubtful debt 25,000 and show balance as 75,000. So now there are several AS who will tell you how the presentation of certain accounting treatment should be done in the financial statement. That is in P&L and balance sheet, how things has to be presented. That guidance is being covered under presentation aspect, so that the user can understand that in a better way. They can read and interpret that in a better way. Got it? Not got it? Then comes disclosure. Means recognizing an entry in the books of accounts, presenting them in the financial statement alone is not sufficient. There are some data which you have to disclose. So disclosure of transaction and event in the financial statement. You have to give notes. You have to give explanatory statements. You have to give additional statements or information, upon reading which I will be able to understand about your company. I'll be able to understand your financial statement in a better way. For example, current year company has declared the dividend. Which dividend? Final dividend. For this period, the dividend has been not declared. Let me say dividend has been proposed during this period. The proposed dividend, where are we supposed to show in the financial statement? As contingent liability in the notes to account, so that the user of the financial statement can understand that, okay, the company for this financial year has proposed so much of dividend. Like that, they will be able to get the information. All of you know that the dividend which is proposed but not yet declared, for that you cannot pass the entry. We have studied this where? Two places. One in 12th standard, second in CA Foundation, third when we did Schedule 3. Schedule 3. So 3 times we have discussed this concept. So by now you should be knowing this point. So a dividend which has been proposed, you cannot pass an entry for it unless and until it is been declared, right? So therefore, no journal entry can be passed for proposed dividend. So how will the user know whether the dividend has been proposed by the company or not? So for that reason, the AS in the disclosure aspect, they said that for this, though you cannot record the entry, but at least give a notes, information, disclosure or points in the notes to accounts, so that they can read and understand this particular point. Got it? Not got it? Like that, there's so many places where the disclosure is required. Disclosure means what? Information to be given in notes to accounts. This disclosure has got nothing to do with trading P&L and balance sheet. They are talking about the information to be given in the notes to accounts. Sir, are all the AS covering all the 4 aspects? No. There are some AS which will cover all the 4 aspects. There are some AS which will cover only first 2 aspects. Some AS which will cover only first 3 aspects. Some AS covering only 3rd and 4th aspect. So it differs from AS to AS. It differs from the problem to problem. So depending on the problem, the ASB has come out with a solution in the respective accounting standards. Got it? Not got it? So when I discuss with you all the respective accounting standards, I will tell you that in this particular AS, what aspects are they trying to cover? Got it? Not got it? Fantastic. Now, what is the status of accounting standard at present? In total, the Institute of Chartered Accountants of India, through its Accounting Standard Board, has issued a total of 32 accounting standards over time. When was ASB constituted? 1977. Till date, we are in 2026. A total of 32 accounting standards were issued by ICAI. Okay, not okay? Now, out of this 32 AS, 30, 31 and 32, the last 3 AS relating to financial instrument were issued by ICAI, which was recommendatory nature. Means it was not compelled by the ICAI that you have to follow only. They said that if you're dealing with financial instrument, if you want to know how to do accounting for that, then I've given the guidance in 30, 31, 32, follow that. But these standards were never notified by MCA. MCA never recognized them for implementation purpose, because the entire focus of MCA back then was on Ind AS. So they said that instead of having accounting standards for financial instruments, let's have it in form of Ind AS. Let's not harass all the sole proprietorship concern, partnership concern, LLP with these things. If they really want to follow the accounting treatment for financial reporting, you as a CA guide the information given through Ind AS. Don't put in AS and complicate their life. Subsequently, to avoid confusion and ensure alignment with international practices, their concepts were incorporated into Ind AS framework. So we removed that from AS and we incorporated in Ind AS framework. After which the standards were effectively withdrawn by ICAI. Since MCA never gave the statutory recognition, They said, why are you putting this unnecessarily confusing? Then ICAI felt that it is better that we remove here for non-corporates and let's make it applicable for all big, super big companies. For big companies or medium companies, let's not compel them with that. Let's impose this on the head of super big companies. Therefore, this 30, 31, and 32 was permanently withdrawn from the AS. So out of 32 AS, if 3 is gone, what are you left with? 29 accounting standards. Out of this 29 accounting standard, there are 2 accounting standard, namely accounting standard 6, which talks about accounting for depreciation. We merged that with accounting standard 10. Earlier we had accounting standard 6 for depreciation and accounting standard 10 for accounting for fixed assets. So we said that why do we have 2 different accounting standards? Why not merge both of them into one AS? And we gave a new name called as property, plant, equipment. AS10 deals with property, plant, equipment, where we learn how to recognize the asset also and where we learn how to recognize the depreciation also. So by that virtue, this AS6 was withdrawn and merged with accounting standard 10. Likewise, accounting standard 8 dealt with accounting for research and development, which is again a kind of intangible asset. And apart from that, we had AS26 also, where we have the guidance on how to recognize, measure, present, disclose intangible asset. So we felt that why to have 2 different ASs? So we felt that we will scrap this, withdraw this, and merge the accounting treatment for this along with AS26, which is accounting standard 26 for intangible assets. So out of this 29 AS, if 2 AS are withdrawn and merged with the other ASs, how many are we left with? 27 accounting standard has been left with, which has been notified by MCA so far. Got it? Not got it? So out of these, AS1 to 29 were notified by MCA under Companies Accounting Standard Rule 2021, and this 2021 was formerly known as 2006, thereby giving the legal recognition. So out of 32 accounting standards, how many accounting standards was given the legal recognition? 29 accounting standards, of which 2 were withdrawn and merged with other standards. So now in total, how much do we have? 27 notified accounting standards applicable on various entities, whether corporate or non-corporate. Got it? Not got it? Super. Now, accounting standard setting and implementation process. How this accounting standard is being issued by ICAI, that process we are going to discuss. Very important from examination perspective. This ASB of ICAI is responsible for drafting AS and Ind AS. But to draft AS and Ind AS, first of all, they have to identify the areas which requires the solution in form of accounting standard. So they try to identify which all the areas are there where the accounting treatment is not clear, or which are all the areas where the accounting treatment is not even there. So first they will identify the areas requiring the solution. They'll identify the areas which problem is there, which requires solution. Then what they will do? They will constitute small study groups, like how you sit and prepare for your examination. You have a group of friends, you guys sit together and discuss, chat, waste time. Sincerely you study, all of you? Okay. So like that, same sincerity has been maintained by these study groups, and they will try to understand the problem in more depth, and they'll try to come out with solution. And they'll come out with a preliminary draft of accounting standard. So study groups, there are small various study groups of ASB who will come out with the preliminary draft of the accounting standard. This will consist, what should be the objective of AS? What is the objective of this AS? Second, in this AS, they'll try to mention what is the scope of this AS. For example, scope of AS means, I told you the other day in regular class that if I'm teaching you, I'm into service industry. So I have to record my revenue. I have to record my income. The guidance of this is given in AS9. However, if I'm into construction business, I'm undertaking construction contract. So for that, how to record revenue, that is not covered in AS9. For that, a separate AS has been prepared, which is called as Accounting Standard 7. So in AS9, they very clearly told that what is covered in this series and what is not covered. So they have to mention that what is the scope of this AS, where and all this AS9 is applicable and where it is not applicable. So they have to mention the objective of this AS, what is the scope of AS. Third, they have to give the definition and meaning of various terminology that they use in the standard. The other day I opened this document, AS9 only. You look into this. What is the objective of this accounting standard? which means what aspect are they going to cover? Are they going to cover recognition aspect, measurement aspect, or any other aspect? So objective is stated. Then they are telling that in this AS9, what and all is being covered. This AS9 is applied to which all people. And they will tell this AS9 does not apply to which all people. So AS9 is not applicable to whom? Construction contracts. So this is covered in the scope. This is not covered in the scope. So what is the scope? Covered and not covered is being clearly given by those people. Then they'll have to give meaning. They have to give meaning of the terms that they use. In AS10, if they use the word revenue, then what is the meaning of revenue? If they use the word trade discount, what is the meaning of trade discount, cash discount? Like that, there's so many terminology that they will use inside the AS. So what is the meaning of that? Interpretation of that is being given in this particular preliminary draft. So now, these study groups will identify the problem and prepare a preliminary draft. And this preliminary draft is being circulated to whom people? It is circulated to all the council members. Plus outside bodies. What outside bodies? Regulators, industry bodies, etc., etc., etc. Will circulate to all of these people so that we can take input from these people. Correct? The study group alone cannot decide what should be the accounting standard. ICAI alone cannot decide what should be the accounting standard. You need to take opinion from all the other members of the ASB or other, let's say, regulators or industry bodies or etc. people, so that we can incorporate their views also in the accounting standard. Now, once you circulate the PD to these organizations, you will take views from these different people and make necessary changes in the preliminary draft. So with the preliminary draft, if you make changes or modification given by these organizations or these entities, then the AS that you prepare is now called as exposure draft. Exposure draft. So the finalized copy of the exposure draft is being released in public for getting public comments. So who and all will comment public? You as a CA student, I as a teacher who's teaching AS, like that practicing CS, who are practicing in AS and in AS, they will now give their view that whether whatever is drafted in the exposure draft is okay, not okay, correct, not correct. What are all the points that they have not covered or touched upon? What are the problems that they have not solved? That feedback will be given in the public comment section of the exposure draft. Now, again, the ASB board will consider the reviews given by this public. They will review the public comments. Accordingly, they will modify and finalize the accounting standard. Then this finalized accounting standard is issued, that is approved by the ICAI council members, and therefore it is being issued. And once it is issued, all the non-corporates are supposed to follow the standards that are issued by ICAI, because the standards are made legally applicable. Got it, not got it. But if you're a corporate, the standard that is issued by the standard that is issued by ICAI cannot be mandated upon the companies. If you're a corporate, you cannot mandate them to follow that just because ICAI has issued it. Here, one more additional step will come. For corporates, MCA needs to notify it. So MCA will notify not just like that. They will take the consultation from NFRA. So NFRA will give the inputs. If everything is okay, then MCA will give the notification. Once MCA is giving the notification, then the standard becomes legally applicable on all the corporates. So MCA will consult with NFRA. MCA will receive review inputs provided by NFRA. Then they will notify under company's rule. And finally, the standard becomes applicable on the corporates. Got it, not got it. So you might have a doubt here. Sir, if NFRA is giving any suggestion, will the changes happen? Yes. The changes will happen, and then the final AS has been released. Got it, not got it. Okay, not okay. Is NFRA part of these regulatory bodies? NFRA will not come here. The role of NFRA will come only when it is being taken to the knowledge of MCA for the notification purpose. Got it, not got it. So NFRA is the ultimate authority, will give the input. Why? Because if NFRA ka suggestion is being given here, and let's say because of any public comment that is invited here, if you change the point, then it will be a violation of NFRA ka suggestion. So we take the last suggestion from whom? NFRA. And whatever they say, finally that has been implemented. Got it, not got it. This is the entire process. So can we read the process one more time very quickly? First step is identification of the areas where we need guidance on the accounting, whether it is recognition, whether it is measurement, whether it is presentation, or it is disclosure. Now, what is the second step? ASB will constitute various small study groups, and these study groups are supposed to prepare preliminary draft of accounting standard comprising of the objective of AS, scope of AS, meanings, etc., 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 covering all the four aspects wherever possible. Some AS need not cover all the four aspects. If they cover two aspects or three aspects, let that be also, no problem. Then this PD, what they prepare, is handed over to the council members of ICI, industry bodies, regulators, governments, etc., for their review and feedback. So they will go through all of that. If they have any pointers, they will share a feedback. And if we feel that is appropriate, we will implement them into that AS, modify it, and create a final draft called as exposure draft. Now, this exposure draft has been released in the public forum to invite public comments. So in public, who all will come into picture? The practicing CAs who are not a part of ASB, academicians who are not a part of the ASB, and CA students and many other people who are not a part of ASB, they will give comments. So those comments are then implemented, and then final copy of this is handed over to ICA for notification purpose. So once ICA notifies, all non-corporate people have to follow that compulsorily. However, if you're a corporate apnina, there's one more step that you have to follow. You have to get the notification from MCA, which will be given only after consultation with NFRA. So if NFRA is okay with that, they'll give go ahead and MCA will notify it, and then the standard is made applicable on the corporates. Okay, not okay? Okay. Now, the accounting standard developed by ASB of ICI will be considering IAS and IFRS as a base. That is, when any country, or let's say India, is drafting AS or Ind AS, they need to take into consideration the IAS and IFRS so that the accounting standard that they prepare is near to the international standards. Not just that, they will also have to take into consideration the applicable laws, customs, and the business environments. So considering all of this only, the ASB of ICI should be developing the accounting standards. However, AS cannot override the country's laws and its local regulations. So whatever are the applicable laws, customs, and regulations, within that framework only the accounting standards can be developed. As of now, 27 AS is notified as per Companies Accounting Standard Rule 21, formerly known as so-and-so. 27 accounting standards has been notified. Now, the final leg, what is Ind AS? What is Ind AS? Ind AS stands for Indian Accounting Standard. This is a set of accounting standards again issued by ASB of ICAI. So both accounting standard and Ind AS has been issued by ICAI, that is ASB board of ICAI. This is to be notified again by MCA after consulting with NFRA, because Ind AS is applicable on the corporates only. Ind AS is applicable on the corporates only, and wherever corporates is coming into picture, MCA ka notification is mandatory, and MCA will not notify without consulting with NFRA. And this accounting standards which is being developed here are called as converged IFRS. With whom are we converging this? This is converged with International Financial Reporting Standards. So Ind AS is nothing but AS plus convergence of IFRS. Put together is called as Ind AS. Ind AS. So this IFRS is developed by whom people? This is developed by International Accounting Standard Board. Any problem here? Now, how did this Ind AS come into existence? How did this Ind AS come into existence? Now I'll give two choices. In my regular video, I've discussed this elaborately, because from examination point of view, I don't foresee a question to come from this segment. But disclaimer is, ICA is like, judge me, I'll prove you wrong. What we feel is a segment where ICA will not ask question. That is a segment where the question will be asked. So since we have discussed this elaborately in the regular classes, my suggestion is this part alone. It is basically the third lecture of the Introduction to Accounting Standards. You can go back and refer. Or if you feel that, no, sir, we don't want to refer the regular video, in this itself do the revision, Apnina, I'll do the revision. Can you do a fast recap? If you understand this fast recap, well and good. If you don't understand it, go back to the original video and refer. Okay, not okay? Okay. Now, pre-2000, that is before 2000, we were following only accounting standards. These accounting standards were issued by ASB of ICAI. The problem with these standards were that if any company was preparing the financial statement based on accounting standard, only the people within our country were able to understand that financial statement. If any foreigner, let's say from UK, US, any other countries, were trying to read our financial statement, they were not able to understand it. Please tell me, if investors are not able to understand the financial statement, will they have the confidence on the financial statement and the company? The answer is no. Therefore, these people were not investing in our company. So when we don't get the investment from the foreign companies, we will not be able to do good business. If business is not flourishing, if you're not able to do a good business in the country's economy will not develop. Therefore, in 2000, that is post 2000, a huge globalization happened. So what is globalization? This was a process where we were integrating and interconnecting economies across the world. We're trying to integrate our economy with that of the other country's economy. In simple words, we wanted the goods to be imported and exported very smoothly. We wanted the import and export of services to be done very smoothly. We wanted to invest capital in other countries, and we wanted to get the capital from other countries to our country. We wanted to share our innovative technologies to other countries, and we wanted to get their innovative technologies to our countries. We wanted the information to pass between two different countries. But to all of this to happen, it was very important for us to have a common language which both of us can understand. AS was not helping us with that language because AS was a local language. It was a big barrier for these transactions to take place. Hence, to integrate with different country economy, it was very important for us to have an international accounting language, a language where we can also understand, other people also can understand. So people said, why don't you adopt IFRS as it is? So IFRS for us was too complicated. It was too advanced for our economy. So we said that we will come out with our own international language, which is converged with IFRS. Not just that, we also wanted to do globalization of capital market. Means what? We wanted the investments also to flow very smoothly between multiple countries. And investors, before investing, they will definitely review the financial statement. So if you are preparing a financial statement that the investor cannot understand, in that case, they will not invest in your company. Therefore, the company cannot get any foreign funding. So accounting standard was a big barrier for this globalization. With globalization of capital market, Indian companies started raising capital from the global investors. Inconsistencies in financial reporting with international level became a barrier. The financial reporting that you prepare under accounting standard were not consistent, were not at the standards of the international expectations. Hence, the investors were not comfortable with our financial reporting, and gradually they started withdrawing investments from our country. So when this happened in 2006, we made a firm decision that no, let's converge with IFRS and come out with something called as Ind-AS. So ICI, in consultation with MCA, announced the intent to converge Indian standards, that is account standard, with IFRS and not to adopt them blindly, so that the Ind-AS what we develop will be suitable for our legal, economic and business environments. Therefore, in 2011, they came out with first notification with 35 Ind-AS, which is notified by MCA. But due to some reasons, the implementation of this Ind-AS were halted and deferred. One of the issues was tax issue. Apart from tax issue, there were so many other issues because of which the Ind-AS could not be implemented. Again, one such issue or reason was the local companies, Indian companies were not supporting us in implementation of Ind-AS because they did not foresee any benefit out of it. Some of them. So therefore, they did not support in the implementation of Ind-AS process. So this problem went on. In 2014, when the central government got changed, in that the finance minister, honorable finance minister of India back then, late Shri Arun Jaitley, had given a very strong intent and message to ICAI and MCA that you have to work rigorously to develop AS and converge with IFRS. Very clear ultimatum was given by finance minister in that budget. Therefore, in 2015, after this ultimatum, a roadmap for implementation of Ind-AS was brought into picture, where a few set of companies, for example, all the listed companies or those companies which are in process of listing, having the net worth 500 crores or more, to follow accounting standard mandatorily. Which accounting standard? Ind-AS mandatorily. So from 1st April 2016 onwards, all the companies which is listed or are in the process of listing in the stock exchange, having net worth of 500 crores or more, you have to compulsory follow Ind-AS. So they followed AS plus Ind-AS. Both of them went simultaneously because this was a trial period, testing period. So we wanted to test how this has been done. So therefore, both these financial reporting was done parallelly. In next financial year, they said that if you're an unlisted company whose net worth is 250 crores or more, you also now have to follow Ind AS. So in the phased manner, Ind AS was started implementing. Got it? Not got it? Pursuant to this, MCA notified under Companies Indian Accounting Standard Rule 2015 a revised roadmap for phased implementation for Ind AS from the financial year 16-17 onwards for only certain class of companies. And here, the banking companies, insurance companies, and NBFCs are not covered. However, NBFCs were covered in the Ind AS in the subsequent phases. However, till today, the banking companies and the insurance companies are out of purview of Ind AS because these are regulated by different authorities. So they have to prepare the financial reporting as per their regulators. So banking companies are regulated by RBI. So based on RBI's guideline, you're supposed to prepare the financial statement. Whereas insurance companies have been regulated by IRDA. So based on their regulatory requirement, they have to prepare the financial statement. So therefore, on banking companies and insurance companies, Ind AS could not be implemented. Got it? Not got it? So this point, again, I'm not repeating because in regular class, we discussed this elaborately. So I'm not touching this point one more time. Now, there's something called as carve in and carve out. All of you know that Ind AS is convergence with IFRS. That is, Accounting Standard of India got converged with IFRS, which means 90% of IFRS we adopted as it is. But 10% modification was done. 10% modification was done. So these modifications were categorized under three categories. One is called as terminology difference. IFRS said that you call P&L as statement of comprehensive income. In India, we felt that this is a very complicated name. People will not be able to gel with this easily. So they said that let's retain the statement of P&L as the name instead of statement of comprehensive income because people understand P&L in better way than the word comprehensive income. IFRS said that balance sheet should be named as statement of financial position. But we said that no, for several years we are using the term balance sheet even in AS. So we will retain that terminology as it is. So like that, wherever there is a terminological difference, we call this as terminology modifications. Got it? Not got it? Got it. Next, IFRS gave multiple options for particular accounting treatment. For example, to account for depreciation, example I'm telling, don't take it seriously. To account for depreciation, they came out with 6 options. Not genuinely, I'm just taking as example. To account depreciation, they came out with 6 options. In India, we felt that if we give too many options to people, then it is very difficult because too much of cook spoils the broth. Too much of anything is good for nothing. So if we give too many options to the people, then each one will come out with different options, and that will make the financial statement not comparable, not consistent, not understandable. So we have to restrict the options. So what they did, the multiple options given by IFRS was removed, and limited options were given by Ind AS. So IFRS allowed companies flexibility where they can choose between different methods of accounting for transaction. But under Ind AS, these choices were removed to promote uniformity and reduce the subjectivity. Subjectivity means what? If I give choice to you, you will feel that method 1 is better. You will feel that method 2 is better. You will feel that method 3 is better. Like that, each one will come out with different methods. So that will not make the financial statement comparable. To remove that, they said we have to come out with limited choice. And the third difference is difference in the economic environment. Means what? There were some policies and principles suggested in IFRS which was suitable to them, to their business environment, legal environment, and economic environment, but they were not suitable for us. So considering our economic environment, we decided to remove certain items from IFRS while implementing Ind AS. So we removed or modified some of the requirement of IFRS in the Ind AS. When I say remove or modify, means at the principle level, at the policy level, certain points were completely eliminated. Such is called as carve out. Such activity or such movement is called as carve out. What is the meaning of carve out? When India does not adopt a particular IFRS accounting principle and policy, they have not adopted a particular accounting principle and policy, which means they have removed it or departed from it. That is called as carve out. Why have they done that? So that this Ind AS can be prepared or it will be consistent with the Indian economic environment. Got it? Not got it? So whatever the principles and policies were suggested by IFRS, they were contradicting our Indian laws. They were against our laws, let's say Companies Act or SEBI, or the Indian companies had difficulty to incorporate them. We had some challenges in incorporating them. Therefore, we felt that it is better that we deviate from those practices. Got it? Not got it? This is called as carve out. This is called as carve out. What is carve in? Any point which was not there in IFRS, but we added from our end, extra flavor that we added from our end is called as carve in. Adding a requirement in Ind AS which was not present in IFRS is called as carve in. Additional guidance or additional requirement given by Ind AS which is not present in IFRS is termed as carve in. For example, there's something being suggested by Schedule 3. To comply with Schedule 3, they said that these points we have to bring in, this principle and policy we have to bring in Ind AS. So if such policies are brought in, that is called as carve in. Got it? Not got it? So how many differences are we talking about? 3 differences. First is terminology difference. Second is removal of options. Third is complying with the economic environment of the country, right? The first 2 options what we discussed, terminology difference and removal of option, does not lead to carve out. Just because you had a different terminology, but just because you have reduced the choices of the option, it does not mean it is a carve out. So carve out means what? The third point which says that there is a particular accounting policy or accounting principle which we deleted, which we removed, which we have not considered, and we have come out with a new policy, new principle appadina, that is carve out. We have deviated from the IFRS, that is called as carve out. And the new thing that we have brought inside is called as carve in. With this, the revision of this entire chapter has been done. All the points covered in this chapter has been taken in this revision series. Now what are we going to do is, we'll very quickly go through the MCQs that has been given in the ICI module. So please take page number 1.30. MCQs. Accounting standard. Accounting standard for non-corporate entities in India are issued by accounting standard. I didn't say Ind AS. For non-corporates in India are issued by. Can I want to meet ma'am and go inside? Tell me people. For non-corporates is issued by ICI. Online people, even you may answer. Is the option C correct here? Online people, are you all there? Okay. Next. Accounting standard. Why is accounting standard implemented? To harmonize accounting policy, eliminate non-comparability of the financial statement, or improve the reliability of the financial statement, or both A and B, or to manipulate the data of the management. I think manipulation is the right answer. Accounting standard is drafted so that we can manipulate the data. Hell, it is both A and B. We want to harmonize accounting policies and eliminate non-comparability because we wanted the financial statement to be comparable and reliable. Got it? Not got it? So the right answer is C. It is essential to standardize the accounting principles and policies in order to ensure transparency, consistency, comparability. So the answer is all the above. D is the right answer. D is the right answer. Which committee is responsible for approval of accounting standard and their modification for the purpose of applicability to company? Who is responsible for approving the accounting standard? Approving means what? Notifying. Who can? MCA is the right answer. Any problem? NFRA, can they approve? They can only give opinion when being consulted by MCA. Central Government Advisory Committee is not involved here. IASB is not involved here. Got it? Not got it? Fantastic. Now, 5th point. Global standard facilitate. Global standard means what? Ind AS is called as global standard. If global standard is coming into picture, if Ind AS is coming into picture, what is happening? Cross-border flow of money. What is cross-border? Between countries, flow of money will happen very smoothly. I can bring in investment and I can invest money in the other countries. Cross-border flow happened. Second, the financial statement could be compared. The financial statement that you prepared was uniform and transparent. Can I say all the 3 happened? Because of having global standard, all the 3 happened. Hence, all the 3. D is the right answer. Any difficulty? They asked a theoretical question. What do you mean by carve out and carve in Ind AS? I don't expect in descriptive paper, all of you know that your paper is for 100 marks, in which 30 is MCQ and 70 is descriptive paper. Out of 30 MCQ, there'll be 15 MCQ each of 2 marks. There'll be 15 MCQ each of 2 marks. In that, they will try to incorporate a lot of these chapters and accounting standards, right? So these kind of MCQ questions can be developed and maybe a little bit more complicated. Case-based MCQs are the major question that they are asking, not direct ones. These are direct ones. Direct ones are very limited. Let's say out of 15 ASs, out of 15 MCQ, hardly some 2, 3, 4 will be direct MCQ. Rest all will be case-based MCQ, where all these points from different chapter and As they'll combine and ask. And 70 mark is descriptive paper where they'll ask you to solve the questions. If at all this theory question will come, it should come in this only. But the probability of asking a direct theory question is very limited, because the major focus is on practically working out the. But at least we should be knowing what it is. If not from the theory perspective, at least from MCQ perspective, you have to know it. Got it, not got it. Chalo. I have few more questions for all of you. Accounting standard becomes mandatory when ICAI issues it. Does it become mandatory? No. I said to you in the regular class that whatever accounting standard has been issued by ICAI, it is not necessary that the non-corporates will follow only. I gave you the example of Babu Pani Puri Wala. Babu Pani Puri Wala is making a turnover of 30 lakh rupees, 40 lakh rupees. Do you think he will follow AS? Go and ask. There are so many business people whose profitability or turnover is, let's say, more than 15, 20, 30 lakh rupees. But they'll not comply with AS. So can you penalize them? Can you put them in jail? Not possible. So how do we make them apply AS? When these people have a need and necessity. What need and necessity? Imagine they want to go for a loan. So for loan, they will come to banker. They'll go to banker. Banker will tell that, go and take the financial statement signed by auditor, CA. Now that is when, as an auditor, I can enforce them to follow the accounting standards. So whatever accounting standards are being issued by ICAI, it is applicable on our members to implement it. It's not applicable on the non-corporates directly. Why? Because ICAI is not the regulatory body. It is not what you call the legislative body. So whatever law they frame, it is not binding on the business entities or non-corporates. It is binding on members only, not on outside peoples. So here, accounting standard does not become mandatory when issued by ICAI. So when does it become mandatory? When drafted by ASB? No. Approved by NEFRA? Does NFRA does approval? No. So only it becomes mandatory when notified by MCA. Notified by MCA. Got it, not got it? No. The answer is B. Recognition refers to, what is the meaning of recognition? When to record is recognition. How to record is recognition. How much to record is measurement. When to present, where to present, presentation, disclosure. Any problem? So answer for this is A. Measurement refers to amount. What amount should I record the entry for? Amount. Presentation refers to classification. Now, land and building, where should I show? Under non-current asset. Cash and cash equivalent, where should I show? Under current asset. So presentation part is taken care as classification. So classification of the items in P&L and balance sheet is being dealt with presentation aspect. Disclosure refers to notes, additional information, explanatory statements, whatever they say, all these are a part of your disclosure. This is the right answer. IFRS are issued by IASB. What is full form of IASB? International Accounting Standard Board. IAS were issued by IASC. IASC का full form International Accounting Standard Committee. India follows convergence strategy. Carve out means removal of options, removal of principles and policies suggested by IFRS. What is carve in? Addition of the points which is not mentioned in IFRS. Exposure draft means what? Once the exposure draft is ready, we put that into public forum for public comments. So this is called as public draft. The draft that is prepared for the public is called as exposure draft. What is preliminary draft? The preliminary draft is prepared for the internal review purpose. So internally, I say council members, regulators, government authorities, etc., will review who are a part of ASB. So ASB ka members will internally review a document called as preliminary draft. Then you make modifications to this and you get as exposure draft, which is given to public for public comments. Total AS issued and notified so far. They have not only issued and notified. How much it is? 29 accounting standards. Got it, not got it. In that, 2 are deleted. So if 27 is given, what will you select and come? 27 you will select and come. If 29 is not given here, then what will you select and come? 27 you will select. Sir, if they give both 29 and 27, imagine this is not 20, this is 27. Then what will you select? 27 you will select and come. Because it is issued and notified as 27 as on today. Got it, not got it. As 30, 31, 32, where? Recommendatory. It was never mandatory. It was only recommendatory. Okay, not okay. Okay. USA follows US GAAP. UK follows IFRS. UK follows UK and European countries and many more others. They follow IFRS as it is. AS improves profit, tax, cash. No, they'll improve comparability of the financial statement. Very good. AS limitations. Is AS flexible? No. Is it comparable, reliable? It is rigidity. It's a little twisty question, huh? It is rigidity. It is rigidity. It's limitation. Sorry, not advantage. Advantage is what? Flexible, comparable, reliable. Limitation means what? Disadvantage. It's too rigid. Means what? Options are very much limited. We don't have too many options. So limitation means disadvantage of AS. It's very rigid. Got it, not got it? Okay. GAAP includes only AS, concepts and standards, tax rule and audit. This GAAP tells you how to do audit. Does it talks about tax rules? Is it accounting standard? No. It is a concept and the standard based on which accounting standards are developed. As are generally rule based. Ind AS are principle based. ASB is formed by ICAI. Tak answer. Imagine, had I not spent the time, this much time for this topic, you'll be literally thinking and blinking that what should be the answer for this. The amount of revision that we have done, no? The amount of discussion we had in depth, that has made your life easy right now. Objective of AS. Is AS developed so that we can save tax, earn profit, reduce cost? No, it is to ensure that the financial statements are prepared uniformly. What is not the objective of the AS? Tax saving is never the objective of the accounting standard. Exposure draft is given by ICAI only, gives the exposure draft. Accounting standard becomes mandatory when notified by MC. Is it repetitive point? Repetitive point, no? I'll remove this. Repetitive point, no? NFRA is established under Companies Act 2013. The primary role of NFRA in relation to accounting standard is, are they into drafting AS? Drafting of AS is with ASB. Are they issuing AS? No. Issuing of AS is done by ICAI. Are they notifying AS? Notification is done by MCA. So what is the role of NFRA? Recommending AS to MCA. Monitoring and enforcing compliance of AS and auditing standards by the companies. Any of these 2 points you can select and come. Correct, not correct? Actually, the word recommending also is not correct. They give advisory to MCA with regard to AS. Recommending of AS is done by ICA. ICA will recommend the AS to MCA. MCA will consult. So MCA will give advisory on AS to MCA. So I'll change this as advisory. Advisory on AS to MCA. They provide advisory on AS to MCA. This is the right word. Removal of an option available in IFRS while framing Ind AS is carve out. Removal of an option. Is it correct? Is it carve out? Removal of options, I said. Is removal of option carve out? When you're deviating from principle and policy, that is carve out. I'm removing options. Means what? In the principle, there are 6 options. In that, I'm removing 4 options. Upon a remaining 2 options, which is based on the principle only. No. Am I changing the principle? No. So, removal option is not carve out, neither carve in, nor full adoption. It is neither carve in nor carve out, which is 30C. 30C. Okay, not okay. With this, we're done with this chapter. So, guys, online people, comfortable so far? I think we took nearly about 1.5 hours to complete the revision class. We targeted to complete this in 1 hour, but we took 1.5 hours. That's okay. Can I wind up? Chalo. So guys, that's all from my side for this revision series. I'll get back to you in the next class with the next new revision series. Until then, bye-bye. See you. Take care.